For joining us this afternoon. So it is a third day of losses in a row, although we did manage to recover a little bit before the end of the session. What did you make of the movements today?
That's right, 3 days of losses now, and the market's corrected back just over 3% from the highs we saw on March 11. Now, actually, we've seen 6 out of the 7 last trading days lower, and that's the first time we've seen that since November 2012, when we saw that 5% correction in the market back then. So at the moment I'm looking at 48.90 on the market. That's on the ASX 200. That's both the 23% Fibonacci retracement from the high. It's also bang on a 5% correction, which is the biggest correction we've seen in this rally since June last year as well. So I think that will be a key level. And the market did recover a little bit. It was off a lot heavier early in the session. It was thanks to the banks as well as the yielding plays in the defensive sectors like the Staples and Telstra. And if we have a look in the banking stocks, there was some pretty big intraday swings. Westpac Bank, it moved as much as 2.5% throughout the session to finish higher. So most of the big fours there helping out during the day, and again seeing a little bit of buying in the dips for the banks, which we have been seeing recently. But we have been seeing some growing calls from brokers saying the bank's looking overvalued and expensive at the moment, but sort of can't help to think back when Commonwealth Bank hit $50, and there was a lot of calls in the market then that it was overvalued, and a lot of holds and sells in terms of analyst ratings at $50. It's now rallied 40% since then to top out around $70. I think what was interesting in trade today is we saw the Shanghai Composite come online, and it jumped over 2% today. And usually the Australian market will take a bit of a lead for the afternoon session from the Shanghai Composite, particularly the materials sector. But even though some of the big miners did finish their day slightly off the lows, they were still down pretty heavily. Fortescue, BHP, Rio all off around 3% today. So that jump in the Shanghai Composite not really helping things. And if we have a look at a chart here of the Shanghai Composite compared to Fortescue, you can see here the correlation's very close, but recently Fortescue's been a very big underperformer of the Shanghai Composite there, so that may well present an opportunity moving forward. So I think we'll get a bit of a read out of China tomorrow. We've got the HSBC flash PMI read, so that'll give us a read into the economy after a bit of a slow start through January and February the official figures have been showing.
Tim, because despite these sort of bearish technical momentum indicators, we have seen those dips still being strongly supported.
That's right, and the trend has been very strong as mentioned there, but it has been a pretty interesting rally we've seen since mid-2012. Usually when we see such a strong rally in the markets, it's usually often led by one small cap stocks usually perform very well in that kind of market, and over this rally we haven't seen them perform particularly well. And the other interesting factor we've seen is the materials and resources have dragged significantly. A lot of this rally has been driven by those key macro risks around the world starting to subside, and usually when that happens it's going to be better for global growth, and usually it's those growth stocks like the materials and resources. They're the most leveraged towards global growth, and they're usually the ones that lead the rally, and they have actually been the big laggards in this rally. And even more frustrating we've seen recently as the market pulls back, they've also been the stocks which have pulled back the hardest. So they've both underperformed the rally moving higher, and they're now pacing the losses we're seeing across the market. So very frustrating, and we've seen just a total capitulation in confidence within the materials recently. Certainly news flow from China hasn't been helping, and commodity prices have fallen off a bit, but investors at the moment certainly looking at yield, banks and yield stocks still in favour, but you'd have to say, given the strength of the trend we have seen, I don't think we're in for a big correction.
So do you think it's time, you touched on the fact that, yeah, the small ordinaries haven't really rallied in line with the rest of the market. Do you think it is time for investors to start to take some profits out of those blue chips that have run really hard and start putting them into some of these more cyclical growth stocks that are in that small cap index perhaps?
We have seen some calls starting to come out from some of the brokers. It's time to rotate portfolios from the yielding stocks into domestic cyclicals. I think Macquarie might have come out today saying that. Also saw JP Morgan come out yesterday saying that our bank's looking expensive to the global relative to global peers. So there seems to be a little bit of a sense in the market now that maybe some of these stocks have run a little bit too far. I don't really think the banks you need to sell necessarily. I think they're still certainly a good hold But some of the other yielding stocks that have run very hard, the consumer staples, Wesfarmers and Woolworths, look pretty expensive, and some of the healthcare and property stocks that had a very good run also starting to look a bit expensive, considering what we're in for in terms of earnings through 2013. I think the banking stocks will probably continue to be well supported, but in terms of switching into other sectors, certainly the small caps have been underdone in the rally, so they might be presenting some value in terms of switching now. The materials sector, it's a difficult one to call. We've seen them continue to trend lower, and the saying goes, it's challenging to, it's dangerous to try and catch a falling knife. But certainly, I think materials will be offering a good entry point at some stage, but over the next couple of months, they could well get cheaper than what we're seeing them in the market.
Really hit hard earlier today on the back of Goldman coming out with that downgrade for the iron ore price. We did see a bit of a recovery in some of those losses, though, on the back of some comments from Fortescue's Chief Executive Nev Power out of the Mines and Money conference in Hong Kong, saying that he actually sees the iron ore price sustainable at around US $120 to $130 a tonne. So it really kind of is the tale of two stories, isn't it? I mean, on one hand, you've got Goldman with that call, and then on the ground, you've got Fortescue coming out with that call. How do you expect that to impact that iron ore space going forward?
We're actually seeing quite a lot of mixed messages coming out at all angles within the mining space at the moment. As you mentioned, we had Fortescue come out today, pretty relatively stable kind of announcement, saying expecting iron ore prices to remain around that level. But then you've also got companies like Rio who have been somewhat a bit more negative in terms of their comments. You know, they've been highlighting the fact they're expecting that iron ore prices are going to drop off through to the second half of 2013, sort of reinforcing views in the market at the moment. And a lot of the consensus forecasts in the market for iron ore price still remains well below what we're seeing at the moment. The iron ore price still holding up pretty well. And I think today we saw two big downgrades from Goldman. They downgraded both BHP and Rio, moving Rio to a conviction sell, which is quite a big call, and also downgrading their iron ore forecast, both in the short term and the longer term. And they were citing in the short term that domestic production of iron ore has rebounded stronger than expected. And looking at the longer term, seaborne iron ore demand is just going to slow down and probably going to average around 2%. And the Chinese economy just maturing in general means still demand is going to slow. The rate of growth is going to slow. So we're going to be moving into a period of oversupply for iron ore. But I think this is really well and truly being factored into the iron ore miners' share price at the moment. We've seen such significant fall-offs in the iron ore price, particularly iron ore miners, particularly those pure play players such as Fortescue and Atlas Iron, and the market just really pricing that in. I think there's a chance of a surprise to the upside here if iron ore prices can in fact hold at sustainably higher levels for longer than what the market's expecting. We should see some re-ratings within these stocks, and as these stocks start to get cheaper, we should expect to see a decent rebound in terms of earnings throughout this year for mining in general, and particularly the iron ore companies. And I think the second half of this year may well be a pretty good story for the miners, and I think there's going to be some attractive opportunities in the market because, as I said, really confidence has left this sector completely at the moment. There's certainly concerns coming out of China. We've seen property prices continue to rise there, concerns around tightening, which is going to flow broadly through the economy, and this is being factored into commodity prices in general and iron ore miners. Now, if this is being overdone, then I think with a rebound in earnings expected through this year, iron ore miners might start looking pretty cheap in the next couple of months, and we could be in for a pretty decent rebound. So I think at the moment it's hard to tell. Certainly the trend has moved lower in terms of Rio and Fortescue and BHP. They're starting to trend back towards those PE ratios, could move back below 10 again. And if these PE ratios of some of these companies move back below 10, I think there's some good value there.
All right, just before